India just lost the future. For 30 years, the country built its rise on one quiet bet: that millions of cheap, educated workers willing to staff the back office of the world would always have a place in the global economy. Call centers, coding, customer support, IT services. And the bet worked. India became the digital workforce of the planet. But then artificial intelligence walked in. And in 18 months, it made that entire bet obsolete. We are now watching in real time the most ambitious economic experiment of the post-Cold War era come undone. Not from a war, not from a financial crisis, not from a pandemic, but from a piece of software that can write code faster than a human, answer customer questions cheaper than a call center, and do basic analyst work without sleeping. The country that built itself around being the world's affordable thinking machine, well, that's discovering that the world found a cheaper machine. And the numbers, the layoffs, the market crashes, the rupee in free fall, the graduates with no job to walk into, well, those are no longer warnings. They're the receipt. The world's third largest economy is in trouble. Foreign investors are running for the exits at a pace not seen since 2013. The currency just hit a record low. Tata Consultancy Services, for 2 decades the cornerstone of Indian IT, just announced the largest layoffs in its history. And analysts say that that's only the beginning. The Nifty IT index has crashed harder in 2026 than at any point in 17 years. State Bank of India has overtaken TCS as the country's 4th largest listed company, a swap that would have been unthinkable just 2 years ago. And the most dangerous part is that none of this is the result of a single shock event. There was no Lehman, no invasion, no oil embargo, just a technology that arrived, learned the work, and started doing it for a fraction of the cost. So let's walk through how this happened. Because what's unfolding in India is not just an economic story. It's the first preview of what the AI economy can do to a country that built its entire prosperity on the very jobs that the machines came for first. To understand the size of what's being lost, we have to understand what was built. Let's rewind to 1991. India had just dismantled the License Raj, the suffocating system of state controls that kept the country sealed off from global trade for 4 decades. Foreign capital was finally allowed in, and a small generation of founders saw an opportunity that nobody else was looking at. 2 of them are now household names. Azim Premji took an obscure vegetable oil firm called Wipro and turned it into a software giant by recruiting English-speaking engineers at a fraction of American wages. N.R. Narayana Murthy founded Infosys in 1981 with $250 and 7 employees. By 1999, Infosys was listed on NASDAQ and pulling in over $200 million a year. Then came the Y2K bug. American and European corporations needed armies of programmers to patch decades of legacy code, and they needed them fast. India had the engineers, the English, and the willingness to work for 1/10 of Silicon Valley rates. The contracts flooded in, and by 2000, India's software exports had quadrupled in 5 years. What followed was a methodical climb up the value chain. Voice-based call centers came first, 50,000 seats across Delhi and Mumbai by 2002, handling phone support for Western telecom companies and banks. The business process outsourcing expanded into payroll, HR, data analytics, accounting, and then application development, systems integration, infrastructure management. Entire cities were rebuilt around the model. Bangalore, Hyderabad, Pune, Chennai, Gurgaon, glass towers full of programmers and analysts working night shifts to overlap with American business hours. By the mid-2020s, India's IT and business process management sector was worth $283 billion. It employed roughly 5.5 million people directly. It contributed over 7% of the country's GDP, and it was the single most reliable engine of middle-class formation that the country ever produced. A first-generation college graduate from a Tier 2 town could walk into a TCS or Infosys office, learn a coding language, and then lift their entire extended family into the consumer economy. That was the deal. India would provide a cheap, English-speaking brainpower, and the world would provide salaries. Everyone won. Until somebody, or rather something, found a way to do the same work without the cheap brainpower. The threat that came for India was not the one that anyone was watching for. For 30 years, economists warned that automation would gut blue-collar work first. robots in factories, self-checkout machines, driverless trucks. The middle class doing knowledge work was supposed to be safe, protected by complexity or language or the irreducible cleverness of educated humans sitting at a desk. Well, that theory died in November 2022. When ChatGPT launched and 1 million users signed up in 5 days, very few people in Bangalore or Hyderabad even noticed. Within a year, they would all notice, because the work that generative AI proved best at, the work it absorbed first and fastest, was not assembly line manual labor. It was exactly the work that India had organized itself around: writing standardized code, answering predictable customer questions, processing structured data, drafting emails, generating reports, doing the things that a junior analyst does in their first 3 years on the job. In March 2023, Goldman Sachs put out a research note that should have triggered alarm bells in every Indian state capital. The bank's economists estimated that generative AI could expose the equivalent of 300 million full-time jobs to automation globally. 2/3 of all US and European occupations were exposed to some degree. Up to a quarter of all current work could be done entirely by machines. The most vulnerable category? Office and administrative support. Then legal, then engineering. The least vulnerable? Construction and physical maintenance. Again, construction and physical maintenance. The jobs that are most exposed are precisely the jobs that Indian outsourcing was built on. The jobs that are least exposed are the ones that India never specialized in. The numbers have only gotten worse since. The International Monetary Fund estimates that 26% of India's workforce is exposed to generative AI, with 12% at direct risk of displacement. The World Economic Forum projects that 92 million jobs globally will be obsolete by 2030. The CEO of Anthropic, the company that builds the Claude AI system, has stated publicly that AI could eliminate half of all entry-level white-collar jobs within 5 years. And the entry data from inside the world's biggest tech companies suggests that these aren't predictions, but rather these are descriptions. Reports from inside Microsoft and Google indicate that AI is already producing 20 to 30% of their code. A 2025 Signal Fire report shows that entry-level hiring in the U.S. tech sector has dropped by more than 50% from pre-pandemic levels. The wave is here. It's breaking. And of every country in the world, none is more directly in its path than the one that built its economy around being the planet's affordable knowledge workforce. The first crack appeared on July 27th of 2025. On a quiet Sunday morning, Tata Consultancy Services, India's largest IT employer, the cornerstone of the Tata Empire, a company that for decades cultivated a reputation as one of the more stable places to work in Asia, announced that it would cut roughly 12,200 jobs in the 2026 fiscal year, about 2% of its global workforce of 613,000. The cuts would primarily hit middle and senior management. CEO K. Krithivasan went on the record almost immediately to insist that this was not about AI. The cuts, he told Money Control, were the result of skills mismatches and an inability to redeploy certain roles in a changing operational structure. Not, he emphasized, because AI was producing 20% productivity gains. Not, he said, because the company needed fewer people. The market didn't believe him. TCS shares fell almost 2% the next morning. Analysts noted that when Accenture announced a similar 2.5% workforce cut back in 2023, investors had applauded, driving the stock up 6%. The opposite reaction to TCS told its own story. Wall Street decided that this wasn't a cost-cutting exercise. This was the first visible admission that the people-heavy services model that India spent 30 years perfecting was structurally broken. Reuters laid it out in plain English within 24 hours. The 12,000 cuts, the agency reported, were the beginning of a broader trend that experts said could end up eliminating about 500,000 jobs over the next 2 to 3 years from the $283 billion sector. Phil Fersht, the CEO of IT advisory firm HFS Research, was even blunter. The impact of AI, he said, was eating into the people-heavy services model and forging large service providers like TCS to rebalance their workforces to stay price competitive in a market where clients were now demanding 20 to 30% price cuts on new contracts. But then the leak started. By autumn 2025, independent reporting was suggesting that TCS's actual cuts had already exceeded 30,000, more than double the announced number. The company denied it. The denials did not slow the bleed. Managers told reporters that they were under quiet pressure to add more names to the list. Fears spread internally that the final figure could reach 100,000 over the following year. TCS was not alone. Wipro, Infosys, HCL Tech, and Tech Mahindra all saw the same pressure flow through their numbers. Across the 5 biggest Indian IT firms, gross hiring had averaged roughly 230,000 new employees a year for half a decade. In the financial year ending March 2026, that figure collapsed to about 170,000, a single-year drop of nearly 26% in the industry's primary intake pipe. HCL Tech began openly telling investors that it would pay a small elite cadre of AI specialists up to 4 times the standard entry-level salary, while quietly shrinking the broader hiring base. The model was shifting in front of everyone's eyes. Fewer humans, higher-paid specialists, more software. Bernstein Research went so far as to write an open letter to Prime Minister Narendra Modi in April 2026, warning of a deepening employment crisis, specifically because AI was threatening the high-wage, high-productivity IT jobs that anchored India's aspirational middle class for 2 decades. The TCS announcement was supposed to be a contained restructuring. It turned out to be the starting gun, and the financial markets responded with a verdict that was almost impossible to misread. The Nifty IT Index, the benchmark that tracks the 10 biggest listed software services companies on Dalal Street, has been one of the worst performing sectoral indexes in the world in 2026. As of late April, it was down roughly 25% year to date. By mid-May, that figure had widened to 26%. The index had not seen a monthly drop like it in 17 years. On a single Tuesday in May 2026, the index crashed more than 4% in one session after OpenAI announced a new $4 billion enterprise venture to embed AI engineers directly inside large corporations. The carnage at the level of individual stocks was even uglier. TCS, once India's most valuable listed company, was down 44% from its August 2024 all-time high. Its market capitalization slipped below 9.6 lakh crore rupees. And in a swap that would have been unthinkable 2 years earlier, State Bank of India overtook TCS to become the country's 4th largest listed company by market cap. The cornerstone of Indian IT had been displaced in the national hierarchy by a public sector bank. Foreign investors voted with their wallets. In the first 4 months of 2026 alone, foreign portfolio investors pulled roughly 1.992 lakh crore rupees out of Indian equities. That figure had already surpassed the entire net outflow recorded across all of 2025, which itself had been a record. March 2026 saw a single-month outflow of about $12.1 billion, the worst monthly sell-off in the country's history. Cumulatively, since the end of 2024, Bloomberg estimated that net foreign portfolio outflows from Indian equities had reached $42 billion. The damage to overall market value was even more staggering. From its September 2024 peak of $5.73 trillion, the total value of Indian equities had shed roughly $924 billion, nearly $1 trillion of paper wealth gone. And for the first time in 3 years, Bloomberg reported that India was on the verge of dropping out of the world's 5 biggest stock markets entirely. The rupee absorbed the worst of it. On May 13, 2026, the Indian currency hit a fresh all-time low of 95.80 against the dollar. Just 13 months earlier, in March 2025, the rate had been 85.53. The rupee lost more than 10% of its value against the dollar in barely over a year. A slide that wiped out savings, raised the cost of every imported barrel of oil, and pushed the central bank into emergency intervention. Some analysts began openly discussing whether the currency would hit 100 rupees per dollar before the end of the year. And at the heart of all of it, sitting underneath every market chart and every red ticker, was a single question that the global investment community had quietly decided to answer for itself. The question was simple. If artificial intelligence is going to do the work that India sells to the world, what is India actually worth? Well, the verdict, written in dollars and rupees and falling stock prices, was not kind. In May 2026, it became almost personal. Ruchir Sharma, the head of international business at Rockefeller Capital Management and one of the most quoted voices in emerging market investing, sat down with the Indian Express on April 28th and used a word that nobody in New Delhi wanted to hear. He called India a loser in the AI race. Days later, Bloomberg published a piece arguing that the country's run as a global market darling might already be over. The most powerful voices in global finance were no longer asking whether India was vulnerable, they were asking how vulnerable. And we'll get to what India can still do about this, because there is a path. A narrow one, an expensive one, and a politically difficult one, but a real one. And before we walk through it, take a second to subscribe to Fall of Nations. We dig into the slow-motion collapses, the geopolitical fault lines, and the economic stories that move the world while everyone else is looking at just the headlines. Subscribing's free, and it tells the algorithm to keep this kind of analysis in front of people who actually care about the story. Let's continue. Because here is what makes India's predicament uniquely cruel. The same global AI boom that's hollowing out India's outsourcing sector is making other countries breathtakingly rich. Taiwan, South Korea, two economies that own the global semiconductor supply chain, are the biggest single beneficiaries of the AI infrastructure spend. TSMC and SK Hynix produced the chips and the high bandwidth memory that every large language model on the planet runs on. NVIDIA alone, the American company that designs the GPUs that every AI training run consumes, became the world's most valuable corporation in 2024. India produces almost none of this. Of the global stock of high-performance GPU compute capacity, Indian firms control under 2%. The country holds roughly 16% of the world's AI talent, engineers and researchers, but those engineers are forced to run their training jobs on Amazon Web Services, Microsoft Azure, or Google Cloud, all of which are based in the US. Every major AI workload in India ultimately routes through foreign infrastructure, leaving the country dependent on the export controls, pricing decisions, and data sovereignty risks set by hyperscalers based in Seattle and Mountain View. The hardware gap is the bigger story. India hosted the high-profile India AI Impact Summit in New Delhi in February 2026. Reliance and Adani pledged to combine $200 billion in AI infrastructure spending. The optics were dazzling. The reality, less so. As of early 2026, India's flagship semiconductor project, the Tata Electronics Fab at Dholera, Gujarat, built in partnership with Taiwan's Powerchip, was still in trial production runs. The original target of 2026 commercial output had slipped to at least 2028. The country's other approved fabs, including Micron's facility at Sanand, faced similar multi-year delays in securing equipment, talent, and reliable gigawatt-scale power. For the immediate AI economy, none of this matters. The training runs are happening now. The contracts are being signed now. The capital is rotating now. India is years away from being able to manufacture the silicon underneath any of it. Jefferies, in its closely watched Greed and Fear report from May 2026, calculated that Korea and Taiwan together could contribute roughly 83% of total projected earnings growth across MSC Asia Pacific in 2026. India's contribution, approximately 0.2%. AI-related stocks accounted for nearly 80% of S&P returns. The capital was rotating out of consumption-driven emerging markets into the countries that own the silicon underneath the AI boom. India was on the wrong side of the rotation. India had been the world's coding workforce. It was now neither the workforce nor the infrastructure. And the people paying the price for that gap weren't sitting in Mumbai boardrooms. They were sitting in college classrooms across the country, wondering whether the degree they were finishing would ever buy them a job. India produces roughly 1.5 million engineering graduates every single year. That number's not a typo. It's the largest pipeline of technical talent that any country has ever organized. The system was built deliberately. 3,500 approved technical institutions producing the cheap English-speaking engineers that the outsourcing model needed to feed itself. So for 3 decades, the pipeline worked. Tier 2 colleges in Karnataka and Tamil Nadu sent their best students to placement drives where Infosys, Wipro, TCS, and HCL Tech recruited by the thousands. A first-generation graduate from a small-town family could expect a starting salary that lifted their household into the urban middle class within a year. Education loans got paid down, younger siblings would get educated, and parents would retire with dignity. That pipeline is broken. The Azim Premji University State of Working India 2026 report estimated that fewer than 1 in 10 Indian graduates were securing a stable salary job soon after finishing their degree. Nearly 40% of young graduates were unemployed. The Unstopped Talent Report 2025 found that 83% of the 2024 engineering cohort remained unemployed or without internships. Campus placement drives at major IT firms in 2023 and 2024 saw entry-level hiring contract by 42% year over year. Whole cohorts of students who had spent 4 years studying for technology careers were graduating into a market where the technology that was supposed to hire them was instead replacing them. The mental health cost is starting to surface in places that nobody wants to look. Rest of World published an investigation in early 2026 documenting a rising pattern of suicides among Indian tech workers, engineers and analysts in their 20s and early 30s, many of them first-generation white-collar professionals who carried entire families on their salaries. Sanjeev Jain, a professor of psychology at the National Institute of Mental Health and Neurosciences in Bengaluru, told the publication that suicides had historically been tied to extreme poverty in India. Now, he said, they were appearing in a professional class that felt their jobs had become precarious. The white-collar dream that had carried India for 2 decades was producing a quieter, more invisible casualty list. The consumption fallout was already visible in the housing market. In Bengaluru, India's tech capital, mid-income housing launches in the 40 to 80 lakh rupee range dropped 29% in 2024 alone. By January 2026, over 42% of prospective homebuyers in the city could no longer afford a property priced under 1 crore rupees. Anecdotes started appearing on Reddit and LinkedIn from young developers who stopped house hunting entirely because they couldn't predict whether the job would exist in 2 years. 2 decades of upward mobility were being undone in plain sight, and the families who had borrowed against their futures to put a son or daughter through engineering school were now watching that investment unravel. Not because of a recession, not because of corruption, but because the machines could now do the work cheaper than the kids ever could. The math at the household level is the part that doesn't show up in any market chart. Engineering degrees in India routinely cost 4 to 5 lakh rupees over 4 years, a sum that, for a middle-income family, often involves a collateralized loan against the parents' apartment, the grandparents' jewelry, or the elder sibling's wedding savings. The implicit deal was that the graduate would land a TCS or Infosys offer, repay the loan over 7 to 5 years, and the family balance sheet would reset. When the offer letter never arrives, the loan doesn't disappear. It compounds. Non-performing assets in the education loan segment at India's public sector banks have climbed sharply in recent years, with engineering programs accounting for the largest share of defaults. The institutions that bankrolled India's middle-class dream are now writing off the receipts. And here's where the math turns from individual tragedy into national crisis. India adds approximately 8 million people to its working-age population every year. That demographic dividend was supposed to be the country's superpower, the engine that would lift India past China and Japan to become the world's 3rd largest economy by the end of the decade. The pitch sold in every Davos forum and every G20 summit was straightforward. A young, fast-growing labor force absorbing global service work, building consumption power, and underwriting decades of growth. The pitch assumed there would be jobs to absorb that labor. But the World Economic Forum, in its Future of Jobs report tracking, projects that artificial intelligence will make roughly 92 million jobs obsolete globally by 2030. A ServiceNow research study released in July 2025 estimated that agentic AI alone would redefine 10.35 million roles in India by 2030. Although the same study did project 3 million new tech jobs would be created in their place. The arithmetic is pretty brutal. For every traditional outsourcing seat that AI eliminates, the new AI native roles being created require advanced machine learning credentials, statistics PhDs, and infrastructure access that the average Tier 2 engineering grad cannot quickly retrain into. And the consumption story underneath all of it is beginning to fray. CNBC's Inside India newsletter ran the framing bluntly in April 2026. For 2 decades, 10 to 15 million Indians working in IT services and BPO had anchored what economists call an aspirational middle class, the cohort buying homes, taking flights, sending kids to private schools, driving the consumption boom that powered everything from real estate to fast-moving consumer goods to private healthcare. When that cohort's earning power compressed, every downstream sector felt it. Hindustan Unilever, The country's largest consumer goods company reported a sharp divergence between urban and rural demand by early 2026. Urban volume growth slowed to a crawl, while rural markets actually picked up, an inversion of the pattern that had held for most of the previous decade. Nielsen India data showed urban monthly per capita expenditure on durables and personal care actually contracting year over year. Knight Frank's India residential indexes showed Bengaluru broadly stable in 2026, while Delhi's national capital region recorded a 9% year-on-year decline in sales. Softer demand in exactly the corridors where IT salaries had powered 2 decades of property appreciation. The 2026 Ipsos Happiness Report captured the mood at the household level. India's happiness score dropped 16 percentage points from the previous year, and the top reason cited was financial insecurity. You put it all together, and the picture is pretty hard to miss. The country built its modern economy on a single bet that human labor was cheaper than machines. The machines just got cheaper than the humans at exactly the kind of work the country sold. And the demographic wave that was supposed to be India's biggest asset is about to crash into a labor market that may no longer have room for it. So we come back to the bet. For 30 years, India made a single, focused, brilliantly executed wager that the world would always need millions of educated humans to run its back office, write its code, answer the phones, and process data. The wager built modern India. It paid for apartments in Whitefield. It funded the IIT campuses. It sent students abroad for grad school. It anchored the consumption engine that turned Bangalore and Hyderabad and Pune into global cities. It created, in the space of a single generation, an aspirational middle class of 300 million people who had reasonable confidence that their children would do better than they did. And in the span of roughly 18 months, from the release of ChatGPT in late 2022 to TCS announcing the largest layoffs in its history in mid-2025, that bet appears to have been called. We're not predicting the end of India, of course not. The country is still the world's most populous nation. Its software talent pool is still the largest on the planet. Its consumer market is still one of the biggest growth stories in modern history. The path to recovery exists, and the people most capable of walking it, the founders, engineers, policymakers, are still working it out in real time. But pretending the foundation is intact is no longer honest. Foreign capital is fleeing. The flagship IT companies are firing. The currency is at record lows. The graduates are unemployed. The country that was supposed to lead the AI century may end up being one of the first major casualties of it. And nothing in the architecture that produced 30 years of growth is built for what's happening now. The factories were never built. The chips never got made. The compute infrastructure was outsourced to Seattle. And the human capital, the one thing India did have in abundance, is, for the kind of work that the world is now willing to pay for, exactly the wrong kind. There's a darker reading of what happened, that the world spent 30 years renting Indian brainpower because it was just cheap. That when something cheaper appeared, the rental ended. That the entire arrangement was always going to last only as long as the cost differential held. And that artificial intelligence didn't destroy India, but rather it just revealed that India had all along been just one technology cycle away from losing what it thought it had built. We'll leave this final question for you. Can India still pivot? Can the world's largest engineering pipeline retool itself into something that the AI economy will pay for? Or has the bet already been called and the rest of the world now just slowly noticing? Tell us in the comments. We want to hear from you, and we'll see you next time here on Fall of Nations.